Costello here, Director of CHG Integrated Board. This morning I'd like to bring to you our Integrated Advice Board Plays of the Week. So what is our Integrated Advice Board? It's where we bring different sections of our business to meet in this room every Tuesday. So we've got an advisory section here at CHG, a corporate finance, estate planning, our self-managed super fund division, our wealth division, our finance division, our medical division, and our tax and accounting division. So we bring experts from each part of the business into this room every Tuesday, and we thrash around client scenarios, looking for the best results for our clients across, it might be across their business or across their personal, and how they all interrelate. So we like to say when we meet and, every part of a plan may affect another person's part of a life. So when we're looking at integrated advice, we make sure that it's tested on whether it's their business section, how that would relate to their personal wealth plans. And we come together and get the best scenario for it. So the one I want to talk this morning about is payroll tax. So payroll tax was introduced in 1941 as a subsidy for child endowment in the World War II. It was passed over to the States in around the 1970s, and it still stands around today. And it's a bit of a grudge tax for a lot of employers. So a lot of employers, the current threshold is $750,000 when you've got wages in New South Wales of $750,000. You need to start paying payroll tax. So it's a bit of a disincentive to put more employees on. When as you put an employee on, it's an extra 5% payroll tax for their wage if you're over that threshold, or 5.45 to be exact. So recently the New South Wales Office of State Revenue have increased this threshold, will be increasing this threshold from 1 July to $850,000. So we saw that as a bit of a planning opportunity for our clients. So the Integrated Advice Board Play of the Week this week was in relation to a client who came to us, and they were paying quite significant payroll tax. I think their wages were circa $1 million or thereabouts. But what we also noticed is that their wages they were taking from the business, the husband and wife, were about $300,000. So we looked at this scenario, and it was actually that $300,000 was actually forcing the company into a loss position. So they're carrying forward losses each year, yet paying paying payroll tax and also paying withholding tax on their wages. It didn't make much sense to us. So as a new client, we tested across all the divisions when they come in. These clients were also doing a wealth plan at the same time, where we're looking at moving their commercial property into their self-managed super fund. So there's some great tax advantages in relation to that. But at the same time, we look at all divisions of their business. So what we did as a simple strategy, just change the way they're going to be remunerated from the business. So we looked at, is there a better way than paying wages? And we ticked that and said yes. What can we do? We looked at a dividend strategy. So we changed the way they're remunerated from a wage to a dividend, and that that was a fortuitous result for a number of reasons. If take for example the $300,000 in wages, and we reduce that and pay it out for a dividend, that reduces your payroll tax by about circa $15,000. So a great result there for the clients. Every Tuesday we meet in this office, about 10 of us from all different sections of the business, and we test client scenarios. So if anyone's out there who'd like us to test their business scenario, by all means, give us a call, and happy to run it by the Integrated Advice Board. Thank you.